Hi everyone, this is Michael Kramer, Ma Capital. Today is Tuesday, May 27th. It's around 6 o'clock New York time. So tomorrow things are going to start getting a little more interesting in the markets. You're going to have a pretty quiet morning, and then at 1 o'clock we're going to be getting a 5-year Treasury auction. At the 2 o'clock Eastern time slot, we're going to be getting the Fed minutes. And then in the afternoon, after the market closes, we'll be getting Nvidia earnings. Markets pricing in about a 5 to 6% post-earnings move from the company. Then on Thursday, we're going to get GDP revisions. This will be an important number, I think, just because the initial reading came out negative. So I think people will be paying attention to this just to see if it's worse or better. And again, that's about all it really matters in this case. I don't really think at this point it has a meaningful importance unless it's a really big revision. We'll also be getting PCE numbers. So these numbers are not the same PCE readings that you get on Friday, which are the monthly PCE readings. This is the quarterly number, so this isn't really that important at this point. Initial jobless claims will come in also on Thursday morning, and continuing claims. This continuing claim number has been gradually creeping up as the number of job openings become less readily available. We've been seeing that number creeping higher. And then, of course, on Friday, we're going to wrap up with core PCE numbers and headline PCE. We're looking for 0.1% on the core month over month, 2.5% on the core year over year. Headlines expected to rise by 0.1%. And year over year, we're looking for 2.2. I don't really know that these numbers matter so much. I think it's going to be the numbers that start coming out in May and June and July that are going to matter a lot more. If there's going to be inflation, it's going to start showing up. Everyone's expecting it to come sooner, but I don't think it's going to start showing up in the data until later. And then, of course, we'll get the final reading for University of Michigan. Again, this is just consumer confidence. So the big numbers here to keep an eye on will be the 1 and 5 year inflation expectations, which have obviously risen rather dramatically over the last couple of readings. And then, of course, next week, we'll start getting into the other data flows, such as ISM and things of that nature. We start off with the euro. We've seen the euro begin to strengthen again versus the dollar, although today we did give back some. Again, more broadly speaking, the euro is trending higher. It is above the 10-day exponential moving average. It is a little bit below the upper Bollinger Band, and it looks like it's trying to regain momentum to push higher. And so I think at this point, as long as we stay above this 10-day and as long as we stay above this trend line, I think at this point we're probably looking at a euro that wants to continue to climb. We noted last time that we had only hit the 38.2% retracement level. So this just seemed like a regular pullback. And it looks to me like there's a lot more reasons, I think, for the euro to continue to rise than it is at this point for it to really start materially weakening versus the dollar. When we look at the pound, that is also really pushed significantly higher. Again, today a little bit weaker, but again, I think overall the trend is likely to continue to be higher. We have a nice uptrend that's formed here. We are above the 10-day. When you look at it from this perspective, you have this nice channel forming. This really isn't narrow enough to be considered a wedge. So I think that you have, very strong momentum suggesting that you're going to continue to see the pound strengthening some. We did break out above a really important level. I think support at this 134.20 is obviously key. I would think, though, that the next major level of resistance likely comes at this 137.20 area. Today we saw the yen weaken versus the dollar. There's some news going on in Japan. We've been seeing a lot of movements in their yields over there in the JGBs. Today there was some stories going around that the Ministry of Finance may start looking to readjust allocations around issuance. This meeting's not coming until June, so it's more specifically not coming till the end of June. So there's a lot of things that can go on over in a month in the market's time frame. More importantly, we hit the 10-day exponential moving average. That was resistance. That's where we stopped going higher. And so as long as we stay at or below that reading, I think that the trend probably is still going to be continuing to see the yen strengthening versus the dollar. I mean, the key here is the 140 level. And until you get below the 140 level, it's more range bound at this point. But the general trend since, call it January, has been to strengthen. And I think that trend is probably going to continue. Gold has been really struggling. It can't seem to capture the momentum to hold above 33 and a quarter. It is holding above its exponential 10-day moving average. It's also holding above its 20-day simple moving average. There is certainly room for it to move back up to 3,400. There's room for it to move to 3,450 or 3,500 if it really wanted to. The problem is it just seems to not be able to get out of its way. So what I would say here is that as long as it stays above this 10-day, I think it probably favors upside. But if we see this break in any way and we start really seeing it deteriorate below this level, I think you have to start, again, reimagining or thinking that you're going to see gold prices begin to move lower. Obviously, the hot trade has been for gold to go higher, but the way it's trading, it's not really giving you a lot of confidence, or it's not giving me a lot of confidence that it wants to go higher. And so I think right now, I think you have to use this 10-day as sort of your dividing line between bullish and bearish. So we've seen oil prices kind of just move sideways since the last time we spoke. It's come down a little bit. We were kind of thinking maybe it would, and maybe make a turn higher at some point if this sort of symmetrical shape is going to play out and we're forming some sort of inverse head and shoulders here. I think this just hasn't finished playing out, and we just need to see how this is going to evolve. Right now, I think we could probably be sideways for another couple of days, but clearly if we were to break below 60 and a quarter, that would probably be a negative indicator, because that would undercut all of these wicks on the lows, and that would probably set up a drop back to this, I would say, 57.80 to 55.40 region. I don't know if it's in jeopardy of going lower than that at this point. Momentum is kind of, if you look, you can see momentum is kind of shifting a little bit, but it's not an overly, it's not overly bullish and it's not overly bearish. Here's your downtrend. And you can also say that there's an uptrend that's forming here. So you have what looks like a potential change of trend forming, but you really need that upside movement and above, really more importantly, 63.70 to confirm that breakout and that potential really to go back all the way about 72. In the meantime, the DAX continues to defy, it seems like everything that gets thrown at it. And for right now, it's hard to think anything other than the fact that it's likely to continue to rise. It seems like even with the economic slowdown, it didn't really matter. Earnings estimates have come down. It didn't really seem to matter. This seems like it's more of a story of a market that's catching up to the U.S. indices, and that's allowing for all this multiple expansion to happen. Obviously, there's also fiscal things going on in Europe that's allowing for this to happen as well, with increased spending. And so, again, you're getting this movement in the DAX. And, right now, I think you're just playing it. The easiest way to do this is just to look at where your 10-day is. As long as you stay above that, you're probably okay. That's your support level, and your resistance level probably is the upper Bollinger Band, because that seems to be the case most of the times when we've gotten there. It's kind of signaled, okay, now we're ready for either a minor pullback or a pause. It certainly was the case here. It certainly was the case here. We saw that, in this region here and in this region and over here as well. So that seems to be the underlying theme that we've been experiencing now for some time. If you wanted to, you didn't want to use the 10-day, you want to give yourself a little more room, you could certainly use the 20-day moving average. It makes life a lot easier if you're just using the one indicator. Momentum is still pretty strong up here, approaching 70, not really overbought. So there's still room for it to continue to expand, barring some sort of surprising news. It's tough to be, too negative on this chart at this point. The FTSE is now again struggling at this, 8,800 area, which is not really surprising given that, it's the old highs. given that it was a tough area before. It is the upper Bollinger Band. So this seems like a natural spot for the FTSE to potentially consolidate, maybe get some more moment. Maybe it needs a little more time to consolidate, to build up some more momentum so that it can break out and re-challenge these highs at 8,900. But otherwise, again, this is a pretty bullish looking chart, and it's hard to get too negative on it at this point, as long as this 10-day exponential moving average continues to trend higher. It's more likely than not that the index is going to continue to trend higher. When we look at the NASDAQ, very similar to the FTSE. You've seen it stall out right around this 21,450 area. These are the all-time highs up here. If you measure from this peak here to this bottom here, you can see it's a little bit above the 78.2% retracement level. Ultimately speaking, though, you need to break above this area, obviously, to really think about these highs in here. So this is a very important spot. Right now, again, the trend is higher. You still have room to rise on the Bollinger Band. Your RSI is only about 66. So momentum is certainly still positive. It's still suggesting this can go higher. But really, I think for that to happen, again, you need to have a lot of things go right the rest of this week. Clearly, if Nvidia comes out with results and they disappoint, you can see there's lots of gaps that need to be filled at lower levels. When we look at the S&P 500 chart, I have, drawn in a little bit more. You can certainly make an argument that there's been a rising wedge pattern that's formed in the S&P. Here's your, downtrend from the high on February 19th to where we were just recently on May 19th. Again, if this is a rising wedge pattern and we've just completed something, then we really shouldn't see the index probably advance much past this 5950 to 5970 region. If that happens, then you're basically surpassing this, and then you're talking about moving back to the highs. But again, very similar to the NASDAQ, it still has some work to do. Nvidia's results are obviously going to play a heavy hand in this, and so that makes it very challenging to kind of figure out what this is going to look like post Nvidia tomorrow afternoon. The Dow also has Nvidia in it as well, but it's a much smaller weight. And so you're looking at an index that's a little bit less reliant, but again, it's still going to have an impact. Here you can see, again, uptrend that was broken. So right now, again, I think you're waiting to see how this Nvidia news shapes out and how this rest of this economic data plays out. I mean, this area here at 42,700, call it obviously an important level of resistance. And you can also see that we had actually moved below the 10-day for a couple of days, and we managed to come back. And also, I just wanted to point out, too, that you're right at the 200-day moving average. So we closed right at it today, and that's another important factor. The S&P is hit the 200-day moving average and bounced off of it. The NASDAQ obviously has much more room to work with when it comes to the 200-day. So you're sort of at an important inflection point. These U.S. markets, to me, don't look as bullish as, let's say, the FTSE or the DAX. I'm not saying they can't go higher, because clearly they have work to do to clear those levels. But certainly the trends in the DAX and the FTSE look a lot more favorable to further upside, I think, at this point than these U.S. indices. There's obviously a lot more going on here than there is in other parts of the world as well. So anyway, hope you have a great rest of your week, and we'll see you again next. Bye.